Let's take a rental property generating £300 per month after costs. On paper, that's £3,600 per year. That sounds like a reasonable return, but that's not what you'll actually keep. Once tax is applied, the final number can be significantly lower, sometimes much lower than people expect. And this is one of the most misunderstood parts of buy-to-let. In this video, I'm going to break down how buy-to-let income is taxed in the UK in a simple, practical way so you can understand what those numbers really mean. The starting point is a simple idea. You don't pay tax on the rent you receive, you pay tax on the profit. That sounds straightforward, but the way profit is calculated in buy-to-let is not always intuitive, because not all the costs are treated the same way, and that's where the confusion starts. Understanding this distinction is important because it changes how you interpret the numbers from the very beginning. Let's break that down using a simple example. £1,300 per month in rent gives you £15,600 per year. But that is not your taxable income. From that, you subtract certain allowable costs, things like maintenance, insurance, and some management expenses. What remains after those deductions is your taxable profit. And this matters because if you only focus on rent, you're looking at a higher number that's significantly higher than what actually gets taxed. Many of your day-to-day costs reduce your taxable profit. For example, maintenance work, insurance, and certain management fees can all be deducted before tax is calculated. So if you spend £1,500 on maintenance over the year, that reduces your taxable income by that same amount. This is helpful because it lowers your tax bill, but it also means your real profit is lower than the headline number. So expenses reduce both your profit and your tax at the same time. Mortgage interest is where things become less intuitive. Historically, landlords could deduct all of their mortgage interest from their income before calculating their tax. But that's no longer how it works. Instead, mortgage interest is handled through a tax credit system. This means your taxable profit may appear higher than your actual cash flow, and as a result, the tax you pay can feel higher than expected. This is one of the main reasons why tax can significantly affect returns. The amount of tax you pay depends on your overall income. Buy-to-let profit is added to your other income, such as salary or business income. That means two landlords with identical properties can end up paying very different amounts of tax. A basic rate taxpayer may keep more of the income than a higher rate taxpayer. So your personal situation has a direct impact on how profitable a property feels. Let's bring this together with a simple example. A property generates £3,600 per year after costs. Depending on your tax band, you may keep a large portion of that or a much smaller portion. The difference can be meaningful over time. And this is why looking at pre-tax numbers alone can be misleading. The after-tax position is what really matters. There's also an important difference between cash flow and taxable profit. You might feel like the property is generating £300 per month in cash, but the taxable profit could be calculated differently. This means you could have a tax bill, even when the cash flow doesn't feel particularly high. And that's something that can catch people off guard if they have not planned for it. Some landlords choose to use a limited company structure instead. In this case, the tax system works differently. Profits are taxed at the company level first. Then, if you take money out personally, there may be further tax. This can offer flexibility in some cases, particularly if profits are reinvested. But it also adds complexity and additional considerations. The key point here is that structure directly affects outcome. Two landlords can own the same property, generating the same rent with the same costs, and still end up keeping very different amounts of money. The difference isn't the property itself, it's how that income is treated for tax purposes. For example, someone holding the property personally and paying high rate tax may see a much lower net return than somebody in a different position. And someone using a company structure may have more flexibility in how profits are used or retained. So this isn't just technical detail, it's something that directly changes how a deal performs over time, which is why it needs to be considered early, not after the purchase. Over time, the effect of tax becomes more significant. A difference that feels relatively small in a single year can become very meaningful when repeated over 10 or 20 years. For example, even a £1,000 difference in annual net income becomes £10,000 over 10 years, and that's before considering reinvestment or compounding. This means that small inefficiencies in how a property is structured can lead to much larger differences over time. And that's why understanding tax early isn't about optimism. It's about avoiding avoidable loss over long term. One of the most common mistakes is stopping the analysis too early. Many people calculate rent, subtract costs, then assume the remaining number is their return. But that number is still before tax. And once tax is applied, the final outcome can look quite different. This doesn't mean the deal doesn't work, but it does mean expectations need to be adjusted. Ignoring tax doesn't remove it, it just delays the moment you realize the impact. A more practical approach is to build tax into your thinking from the start. Instead of asking, what does this property make? It's more useful to ask, what do I actually keep? That means estimating profit, applying a realistic tax assumption, and then looking at the net result. Even if the estimate is not perfect, it gives you a much more grounded view of the deal. And importantly, it avoids overestimating performance, which is one of the main reasons deals feel disappointing later on. In practice, this changes how you evaluate opportunities. A deal that looks strong before tax may feel average once everything is included, and a deal that looks average before tax may feel quite tight afterwards. This doesn't mean you avoid investing, but it does mean you become more selective and more realistic about what good actually looks like. Over time, that leads to more stable decisions. The key takeaway is simple but important. It's not what the property earns, it's what you keep after tax that defines the result. Two deals with similar rent can feel very different once the full financial picture is considered. And that's why tax isn't just an additional layer, it's part of the core analysis. Getting that right changes how you interpret every deal you look at. Buy-to-let tax isn't always straightforward, but it becomes much easier once you understand the structure behind it. And the benefit of understanding it early is that it removes uncertainty later. It allows you to make decisions based on realistic outcomes rather than assumptions. And over time, that leads to more consistent results. This is the Practical Landlord.